The fair value gap. Everyone's trading them right now. But here's the problem. Most traders are doing it completely wrong. Do you see this gap? It failed. But this gap worked perfectly. Same strategy, different results.
1, 2, 3, 4.
What exactly changed? Well, I discovered 6 key factors that instantly tell me if a fair value gap is actually valid. And one of them involves a weird word you've probably never heard before. Stick around because once you know these 6 factors, your win rate is about to go crazy. Okay, first things first, what even is a fair value gap? Think of it like this. When price shoots up super fast, it creates a massive candle. Like boom! Giant green candle. It moved so fast that sellers didn't even get a chance to react. This creates an imbalance, a gap in the market, and guess what? Price loves to come back and fill that gap. It's like the market forgot to clean up its mess. You mark it from the top of the candle before the move to the bottom of the candle after the move. That's your fair value gap. And when price comes back to test it, that's where the magic happens. But here's the catch. Not all gaps work. Some fail miserably. Why?
Why?
Because most people trade invalid gaps. So let me show you the 6 factors that separate the winners from the losers. Factor number 1, the gap must be unmitigated. Fancy word, I know.
Luxury forever.
But it just means the gap hasn't been touched yet. Think about it. If price already came back to test this zone once, it's basically used up. The imbalance already filled. So if you try to trade it a second time, you are already late to the party. We only want fresh gaps, gaps that have never been tested. If it's been touched before, skip it, move on. This alone will save you so many headaches. Factor number 2, check the candle reaction. When price comes back to your gap, you need to watch how the candle behaves. Does it close inside the gap? Good. Does it close above the gap? Even better. But if it closes below the gap, red flag. Danger zone. That's the market telling you, nah, I'm not respecting this zone. Now it's okay if the wick goes through the gap. Wicks lie all the time. They're drama queens. But if the body closes below, that gap is dead. Don't fight it. Just walk away. Factor number 3, stack your confluences. This is where you become a trading detective. Look for old support and resistance levels. If you have a fair value gap that lines up perfectly with a previous support level, beautiful. It's like having 2 layers of protection. The market is more likely to respect that zone. Same thing with bearish gaps. Find old resistance that matches your gap. The more reasons you have to take the trade, the better. It's like bringing backup to a fight. Always smart. Factor number 4, not all gaps are created equal. Some are strong, some are weak. But here comes the secret. The lowest bullish gap on your chart, that is the strongest one. The highest bullish gap, weakest. It's like a ladder. The lower you go, the stronger it gets. For bearish gaps, flip it around. The highest bearish gap has the most power. So if you have 5 gaps on your chart, don't just pick one randomly. Go for the one with the highest priority. Work smarter, not harder. Factor number 5. Use the Gann box tool. This one's a game changer. Go into TradingView and grab the Gann box. Set the levels to 0, 0.5, and 1. Then stretch it from the low of the move to the high of the move. This creates 3 zones: upper, middle, lower. Here's the rule: only trade gaps in the lower zone for longs. Only trade gaps in the upper zone for shorts. If your gap is in the middle or wrong zone, skip it. This tool basically does the thinking for you. It's like having a cheat code. Moving on to the 6th and final factor. But before that, I want to show you the broker I use. It's regulated in 3 different countries and offers 1 to 500 leverage, which is quite high but really good if you are starting with a small trading account.
Nice.
If you use my link, you will get a 100% deposit bonus to grow your account even faster. I'll leave the link in the description, go and check it out. Okay, now let's go back to the 6th and final step. When trading fair value gaps, you should have a break of structure before the gap is made. This is the final piece of the puzzle. Before a fair value gap is valid, price needs to break a previous high or low. It's like getting permission from the market. If price makes a gap but doesn't break the previous high, not valid. Don't trade it. But if price breaks that high and creates a gap while doing it, now we're cooking. That's confirmation the market is ready to move. For shorts, same thing. Price must break the previous low before creating the gap. No break of structure, no trade. Simple as that. Alright, let's see this in action. Real trade example coming at you. First we spot this high. That's our break of structure point. We wait for price to break above it. Boom, break of structure confirmed. Next, price creates a fair value gap. We check, is it unmitigated? Yep, never been touched. Now we mark all the gaps and see which one has the highest priority. We grab our Gann box tool and stretch it from low to high. One gap is in the upper zone. We ignore it. The other gap is in the lower zone. Perfect. And look at that, there's an old support level right in the middle of it. Confluence, check. All 6 factors are lined up. And now we wait for price to come back down. It hits the zone and the candle closes inside the gap. Beautiful reaction. We set our take profit at the high, stop loss at the low of the candle that created the gap. And just like clockwork, price shoots up, straight to our take profit. See how powerful this is when you combine all 6 factors? No more guessing, no more praying your trade works out. Just clean, high probability setups. Start using these 6 factors and watch your fair value gaps go from hit or miss to consistently profitable. I also have a group where I share free signals. It's linked down below. If you found this helpful, smash that like button, subscribe if you want more content like this, and I'll catch you in the next one. See ya!